In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and review then rate the company. Today we are going to look at Crocs, ticker CROX. Let's dive into the process I follow when reviewing whether or not to invest in a company. I analyze financial information against the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics achieve or exceed a specific target. Companies can earn 1 point for fully meeting the target or 0.5 points for coming within 2% below the target. Stick around until the end. I'll reveal exactly what I plan to do with this stock and why it could matter for you. Let's start with the first pillar, earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For Crocs, earnings per share growth over the past 12 months is 24%, exceeding the 10% target, scoring 1 point. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. Crocs' free cash flow growth is 17%, also exceeding the 10% target, scoring 1 point. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. Crocs' revenue growth is 7%, which is 3% below the 10% target, scoring 0 points. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. Crocs' book value growth is 30%, exceeding the 10% target, scoring 1 point. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For Crocs, return on invested capital is 27% and return on equity is 52%, both well above the 10% target, scoring 1 point for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow within 3 years. Crocs' debt would take 1.85 years to pay off, which is below the target and earns 1 point. With the information we have gathered, it tells us that aspects of the key pillars are solid, but let's explore the company further. Now let's look at the remaining key pillars which help define an excellent business. Let's look at the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 59%, exceeding the 40% target, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on $1 of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. Crocs' operating profit margin is 26%, well above the target, scoring 1 point. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. Crocs' free cash flow yield is 15.74%, significantly exceeding the target, scoring 1 point. Next, we assess the 10-year book value growth as potential shareholders. For Crocs, this is 138%, exceeding the 10% target, scoring 1 point. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. Crocs' 5-year net income growth is 67%, exceeding the 10% target, scoring 1 point. In the description, I've included a link to the investors page and the annual report if you want to check it out for yourself. Crocs has demonstrated strong fundamentals across almost all key metrics, with especially impressive profitability, capital efficiency, and long-term growth in book value and income. As of today, the stock is trading at $97.68. Over the past 6 months, the stock has moved sideways with fluctuations with the market and lower revenue reports. Looking at the overview, we can see the current market cap is approximately $5.48 billion. They are currently generating $4.10 billion in revenue for the trailing 12 months and have 56.6 million shares outstanding. At present, their earnings per share tell us that for each share of stock, the company is generating $15.88. Their price-to-earnings ratio is 6.15, which is significantly below the S&P 500 average of 27.14. The overall consensus among analysts is a strong buy, with a 12-month price target of approximately $133. Analysts are forecasting an average EPS growth rate of 5% over the next 5 years. Let's calculate a valuation. I will use Crocs' current earnings per share of $15.88. Combining historical growth rates and future analyst predictions, I estimate an earnings per share growth of 5%. Assigning a forward price to earnings ratio of 10, projecting 10 years forward, and applying a desired return rate of 10%, this results in a future stock price of about $259. The current intrinsic value is about $100, with a margin of safety at $74.80. Since the current price matches the intrinsic value, this scores a check. The margin of safety all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. When reviewing the key pillars, Crocs scored 11 out of 12, earning a check. Over the past 6 months, the stock has moved sideways due to market volatility, typically selling off during these periods but historically rebounding to between $124 and $154, thereby achieving a check. Analysts are predicting a growth rate of 5%, scoring a cross. My main concern with this otherwise strong stock is that its revenue appears to be declining, and if an economic downturn does occur, Crocs is the type of product that could experience an even greater drop in revenue. The valuation matches the intrinsic value, signaling a check. However, if the market was to have another dip, I could see this hitting the margin of safety price. According to Morningstar, Crocs has a narrow economic moat, which scores a check. Thanks for sticking with me. Now let me share my personal thoughts and opinions on this company. My final overall rating is 4 out of 5 stars. Crocs remains a strong contender in the consumer discretionary space, with solid profitability, value pricing, and long-term growth prospects. However, a note of caution is warranted. Their revenue is declining, and the acquisition of Hey Dude has not yet integrated into the business with the same level of success as the core Crocs brand. For full disclosure, this is a company I have owned in the past. I sold my position when it reached around $125, after purchasing it at $85. Given the current market uncertainty, I would prefer to see it reach my margin of safety price before considering a re-entry. After all, real money is made when you buy a stock at the right price relative to its true value. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.